All right, hi everybody. Welcome to video lecture 3.3. We're talking about aggregate supply. So we talked about aggregate demand, jumped into the multiplier, and now aggregate supply, the other side of it. Let's get to it. If you're a definitional kind of person, you can write this down. But aggregate is a stand-in word for all. So we're not just looking at the supply of one business to one industry. We're looking at the supply of all businesses to the entire economy. So there are the words that say that. That's what aggregate supply is. It's all supply of all businesses that they're willing to sell at a given price level in an economy. Okay. So before we dig into aggregate supply, we actually have two time horizons. In reality, there are three time horizons, but we're going to investigate two of them because you no longer need to know the third one. So why would I teach something that you don't need to know for the exam, right? So the first time horizon we call the short run. You've actually probably heard me use these terms in class already, and you've probably heard or seen it show up on AP College Board questions at some point too. So, what do we mean by short run? In the short run, it's all about input and output costs, or input prices and output prices, same thing. In the short run, input costs, so the cost of paying my workers, which is probably the easiest one to think of, they're fixed, right? Like in the middle of the day, I can't go to a worker and say, hey, you didn't do a very good job today, so I'm paying you $5 an hour less than I was planning on paying you. It's not how it works. You'll get sued, you'll go out of business. Can't do that, right? So in the short run, I have to pay my workers the amount I committed to. And normally that short run is like a year, or depending on the industry, sometimes they're 5-year contracts, like in the education industry. But my output prices are flexible, right? My output prices are flexible. So it's commonplace. I don't know if this ever happened to you. You go to a store and you buy something at a certain price, and then you're visiting the store like a week later and you see the same product you just bought for a lower price, right? So that output price is actually flexible. We call this the short run. I have to pay my workers the same, but I can change the price of my products. We actually kind of did a little preview of this before. This is what causes the upward sloping short run aggregate supply curve, or SRAS, SRAS. Because in the short run, when price level rises, I change my output prices, but I pay my workers the same. So I'm profitable. I'm excited about this. This is one of the reasons businesses benefit from unanticipated inflation, right? When price level rises, I get profit, so I increase production. That creates the upward slope of short run aggregate supply. So generally speaking, when we're before we're at full employment, it's a pretty flat line, meaning that even slight changes in price level will result in enormous gains. But as we get closer and closer to full employment, people will be more willing to negotiate higher wages, and it gets steeper. That's why you have this kind of scoop or ramp type of shape here. Not really all that important. Just know that it slopes up because after a bit, the per unit production cost starts to rise. We'll talk more about that when we get to long run. Big takeaway here, know that in the short run, input prices are fixed. The price I pay my workers is fixed. Output prices are flexible, which is why when price level goes up, my quantity I'm willing to supply goes up. So if I'm looking at this right here, my price level is low, my quantity I'm willing to supply is pretty low. Price level goes up, I don't have to pay my workers anymore. So that just becomes profitability. So businesses are going to increase the GDP they contribute to the market as a result in the short run. Okay, let's keep going. For example, if a firm makes 100 units that are sold at $1 each and their only labor cost is $80, what's the total profit? Well, they sell each unit for $1, so total revenue is $100. Their cost of labor is $80, so the profitability is going to be $20. However, in the short run, the price level doubles. What's going to happen? Well, my price level doubles, so I sell those 100 units for $2 a piece. So my revenue is $200, but I still have those fixed input prices. They're only $80. 200 minus 80 gives me a profit of 120. Notice I sold the same amount as I did before, but because of inflation, I have increased profitability. We know when businesses are more profitable, they produce more. That's why short run aggregate supply is upward sloping. Price level rises, they produce more. Okay, second horizon is called long run aggregate supply. The long run. In the long run, both our input and our output prices are flexible. In the long run, I can give people raises that work for me. In the long run, I can lower people's wages that work for me. That's fine. Over a long enough timeline, I'm able to renegotiate those things. So input prices are flexible and output prices are flexible. What's going to happen on a long enough timeline? When price level rises, my workers, I get those temporary profits, but eventually, in the long run, my workers are going to negotiate a higher wage because that inflation is harming them. They're fixed income workers. They're hurt by unanticipated inflation. So I'm going to have to pay them more. So I'm not going to increase production, right? So as a result, I'm actually going to have a fixed quantity. Any temporary gains I got from an increase in inflation goes away because I have to pay my workers more. And oh, by the way, I ramped up demand on my other inputs like lettuce and bread for my sandwich business. So those prices went up as well, and it erases any of those gains that I had. So we always end up right back at the same place. We call this place full employment. So long run aggregate supply is vertical, fixed, right? Price level can go up and down, but GDP is going to remain the same. And that GDP is going to be our full employment GDP, right? So what's it look like? Long run aggregate supply. In the long run, price level increases, but GDP does not. It looks like this. Normally we have it at QY or GDPY, which is full employment trend. That's exactly where we want to be. In the long enough timeline, incentives are in place for our economy to produce at full employment. This is the term that many free market economists call leave it alone, supply takes it home. Right? We will always end up back at full employment if we don't get in the way. The problem is politicians are always getting in the way. Okay, so let's take that same example, right? A firm makes 100 units, sells them for $1 each, and the only cost is labor. The profit is 20 bucks, right? Well, what happens in the long run if that price doubled? Remember in the short run, price level doubled? Well, in the short run, when price level doubled, I went ahead and got those additional profits, $100 more profits. That's awesome, right? Because my input prices were fixed. But in the long run, when price level doubles, my wages are going to rise to match that. My workers are going to say, wait a minute, it's more expensive for us to live. We need a higher wage. And so not only does my total revenue go up to $200 like it did before, but also my costs go up to $160. Now it still looks like my profits rose, right? I'm at $40. But notice my profits didn't actually rise. The real value of that, because prices have doubled, the real value of those $40 is still 20 bucks. The only reason it's a larger number is because of inflation. So when I correct for inflation, it's $20. In other words, in the long run, because wages and all other inputs are flexible, we will end up back at full employment GDP. Right? We'll have those gains that we get from inflation initially for businesses go away in the long run, and we end up back where we're supposed to be. Okay, so we produce more output when price level goes up, and then in the long run, we produce less, which puts us right back on the full employment trend on long run aggregate supply. A couple of examples for you. Example number one. Let's say in the long run, you overproduce as a business, you're producing too much. So initially, you get profits. We just talked about that. Price level went up. Your input prices are fixed. Your output prices are flexible. You're profitable. However, you're overproducing. So you're overworking your labor. When you overwork your labor and prices are rising, your workers are going to ask for increased wages. When wages go up, your profitability goes down. When profitability goes down, you decrease production back to where you're supposed to be. So is it possible to temporarily overproduce? Yes. But in the long run, we'll end up back where we're supposed to be. Example number two, in the long run, let's say you're underproducing, you have a recession, right? When you have a recession, you're underproducing, you have lower profits. People aren't buying your goods and services. So you lay people off, you fire people. When you fire those people, eventually they're going to want back in and they're going to accept lower wages. They'll say, yes, we'll accept lower wages just so we can have a job. Having a job is better than having the high paying job from before. So when they accept those lower wages, there's an increased profitability. When there's increased profitability, you increase production back to full employment GDP. In other words, in the long run, recessions will eventually go away. Inflationary gaps will eventually go away and will always produce at full employment GDP, which is indicated by long run aggregate supply. There's that input costs will always change to equal the change in output costs. Input costs and output costs will become the same again. And that self corrects our economy. If we just didn't get in the way, we would always be back at full employment eventually. Now, what do we use in economics to actually demonstrate this? We use the short run. So whenever I say aggregate demand, aggregate supply, what I mean is draw short run aggregate supply and aggregate demand. It is perfectly fine to label it just AS instead of SRAS, but that's totally up to you. The reason we use this is this actually shows us how the business cycle works. It indicates to us when we're in a recession, when we have an inflationary gap. It demonstrates how businesses actually respond initially. And then later on, we'll bring in the long run and we'll show where we get back to full employment GDP and how we do it. So what changes aggregate supply? Well, we know change in price level will change profitability, which changes the quantity of aggregate supply businesses provide. Just like a change in price in a market will change the profitability for a firm, and so it'll change the quantity supplied that they provide to the market. Same idea, just the entire economy. So remember, price level, not a determinant. It's just going to be movement along the curve. But there are some determinants that shift the aggregate supply curve to the right and shift the aggregate supply curve to the left. And these things are generally have to do with per unit production cost or just costs in general, right? When costs rise, we supply less. Every firm supplies less because they're less profitable. And when costs fall for producing, our supply shifts right because they're more profitable. So let's dig into it. We have three of them. They actually make an acronym RAP, R-A-P. The first is the resource price changes. This is what we've already been talking about. So input prices impact your total cost. So if I have to pay my workers more, it impacts my total costs. My total costs are rising. And then our supply will shift left and vice versa. If, there's, for example, oil is really cheap right now. So when oil prices go down, total costs go down and businesses are willing to supply more and our supply shifts right. There are also supply shocks that are outside of this. Supply shocks are when, I don't know, there's a forest fire that engulfs an oil rig and now we have less oil available. Well, that supply shock will increase the price of oil, which will shift our supply to the left. So when you're thinking supply shocks, just think unexpected things that will impact the cost of doing business. And then inflationary expectations can have an impact as well. If businesses expect there to be inflation, then they're going to build that into their wages. But if it's unanticipated inflation, it can hit their profitability. And then the price of domestic and imported resources, right? So if I'm importing resources or inputs, it could, and those imported goods go down in price, then it could increase my aggregate supply and vice versa, right? So clearly, anything that changes the price of resources will impact aggregate supply. That's our resource prices. Again, we'll give you examples. It'll make more sense when we do that. The second one is A, it's actions of the government or actions by the government. The government can do a couple of things. They pass regulation. Generally speaking, whenever there's a new regulation, you can assume it's bad for business. Regulation, the saying goes that costs to comply. So whenever I have to comply with the new regulation, it's going to cost me money. Even if I don't actually have to pay money, I have to pay somebody to help me be in compliance with that new law. So regulations hurt your per unit production costs or your PUP and impact the bottom line and will shift our supply to the right or to the left, sorry. And then in the event that regulations or we deregulate the economy, which has been the trend over the last decade, take regulations away, well, we no longer have those costs for compliance. So costs fall, aggregate supply shifts to the right. Taxes, when we increase taxes, it increases costs on businesses. So our supply will shift left. When we decrease taxes on businesses, our supply will shift to the right. If I subsidize businesses, it reduces costs. When it reduces costs, supply shifts right. When I take subsidies away, it increases costs and our supply shifts to the left. You should notice these are very similar to the determinants of supply and markets. We're just applying them to the economy as a whole. Those are resource prices. A, actions of the government, which is regulation or deregulation, taxes or subsidies. Our final one is P, productivity change. Productivity is simply total outputs divided by total inputs, right? So in the event that productivity increases, it means from the same resources I had before, I can produce more. I have more output from the same resources. So if I have 10 workers and they produce 100 pizzas, and the next week I have those same 10 workers and they produce 300 pizzas, my productivity has just gone up. When we are more productive, our per unit production cost goes down, right? Because I'm paying those 10 workers the same amount in week one as I was in week two, but I'm selling way more pizzas in week two than I was in week one. Hopefully that makes some sense. So let's try this out. If my output is 10 units and my input is 5 units, what's my productivity? Oh, and my input cost is $2. What's my productivity? Well, my productivity is going to be 2 units, right? Output divided by input. So for every input, I get 2 outputs. If my input cost is $2 per unit, then it's going to cost me $10 to actually provide this. So when I divide 10 by those $10 of cost, it's going to cost me $1 per unit. That's your per unit production cost. When I jump down below, notice I'm using the same 5 inputs, but now it costs me 2, and it costs me the same price, $2 per unit. So my total costs are going to be $10. My output is 20. So 20 divided by $10 now, I get $2 for every input I put in, right? So as a result, my productivity has increased and my per unit production cost has gone down. $10 divided by 20 is, I'm sorry, not $2, 50 cents. The $10 divided by the 20 units I produce, each unit is going to cost me 50 cents, and I can sell it for a lot more. My profitability will rise. All that to say, when productivity happens, when we're more productive, per unit production costs fall, our supply shifts right. When I'm less productive, per unit production costs go up, our supply shifts to the left every single time. Put it all together, that's RAP, resource prices, actions of the government, productivity. The big takeaways here, the things you need to know: why is our supply upward sloping, fixed input and flexible output prices. What makes up aggregate supply? Know the RAP, resource prices, actions of government productivity. Know the 2-time horizons. Know the second one is long run aggregate supply. And it's always going to be at full employment no matter what. Because in the long run, the incentives are in place for us to go back to producing what we're supposed to be producing. That's it. Khan Academy is ready for you. Good luck. And I'll see you in class.